Despite everyone's fear of a massive recession, the S&P 500 returned an absolutely amazing 24% in 2023. So the question is, now that that's behind us, how should we be approaching investing in 2024? That's something that I'm going to cover in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Many of you already know, and for those of you who don't, really the market optimism and the reason why the S&P 500 was up so much, especially near the ending of 2023, is the fact that the elusive soft landing is really coming into view. And inflation news has been better than expected, and there is no sign of a recession, but the thing that I got to point out is that consumers are starting to pull back. However, it seems like the market is not really concerned about a consumer slowly pulling back or pulling back just a little bit, so long as the recession is out of view. And I think the reason why there's just been so much optimism is just how close we are. This was November's reading to that 2% year-over-year inflation. We're just a stone throws away now, and we will likely see interest rate easing before we get to that 2%. So some of you might be thinking, wait a minute, why would they start to reduce rates before we get to that 2%? Wouldn't that just cause us to not get to that 2% if they start reducing rates, say if it's at around 2.5%? Well, the truth of the matter is that even if you start reducing rates as inflation hits around that 2.5%, it takes a while for that to work its way through the economy. So if the trajectory of the economy, or if the trajectory of inflation is to continue to go down, or if that's the trajectory that it's on, it will just continue to make its way in that direction. What you don't want to do is wait until it gets to 2% and then start reducing, because the trajectory will take it even further, in my opinion. And that's not an opinion that I just hold. I think that the Fed also holds that opinion, and here's where they talk about it. So in the last Fed meeting, they are saying that hikes are largely over. I don't think we're going to see any more hikes, but they're not offering any timetables on cuts. But notice that some officials are starting to highlight the risks of an overly restrictive stance on interest rates as inflation cools. So this is going to be the worry in 2024. Should we reduce rates now or wait a little bit? But know that if we wait a little bit, this could actually hurt the economy even more. And so this is the key to the market surge, because this is what I would consider a more dovish stance than we've heard from the Fed in a long time. And here's the article going into it a little bit more. Here are some of Powell's comments. So he essentially said that he has signaled more concern that he had previously about the risk of causing unnecessary harm to the economy by leaving rates too high as inflation falls. So that's exactly what I had said. So the Fed is now openly discussing their fear of leaving rates high for too long. That is the environment that we're in 2024. And Jerome Powell went on to say, you wouldn't wait to get to 2% to cut rates. It would be too late. And that's exactly the opinion that I share. And of course, that's all the market needed to surge as much as they did from November. And so my first question is, how expensive is this market right now? And there's a couple of indicators that I use to gauge the overall expensiveness of the market, or the overall value of the market, and you can see it here. So the first is the Buffett indicator. And really what it is the ratio of the market value of equities divided by GDP. Now, the Buffett indicator is not as great of a measure anymore, because so many companies generate so much revenue from overseas. And so if you're just comparing that to the US GDP, it's always going to look somewhat overvalued. But if you just compare it to the historical trend line and maybe just look at it from the year 2000, you can see that generally it's between 0 and 1 standard deviation, and you're kind of there right now. You're just a little bit over. You're a little bit more than over. You're at 1.4 standard deviation. So I would be more comfortable if it comes under that 1 standard deviation line, not going higher up and closer to that 2 standard deviation line. I brought this up a couple of years ago when it was hitting that 2 standard deviation line, and we did see a recession, or not a recession, we did see a market correction as a result of that. And so we'll see what direction it's going, but it is suggesting that the market is overvalued, but not strongly overvalued like it was in 2022. And recall back then that I was in a larger cash position than I was in early 2023 after the market had come down and opened up a lot of opportunities. Now I'm kind of a seller as this market is increasing and not necessarily a buyer. So early in 2024, that's kind of been my strategy. I'm still looking for opportunities, but I'm more of a seller than a buyer right now. And then the Schiller PE ratio is another metric that we can use. The historical trend line's been around 17 times earnings, whereas right now it's trading at around 32 times earnings. So once again, I'd love to see this come down a bit, but it is suggesting overvaluation. Now, the other thing I wanted to look at, and this particular data may not be the best, but what I wanted to look at was what were the total inflows into equities, because in much of 2023 we saw a lot of outflows from equities, and now you're noticing that a lot of people have surged back in, especially in December. There was just a massive inflow into equity related funds. Most of it went into domestic funds, but so you can see that investors have put risk back on. So that of course makes me feel a little bit uneasy. I don't think that euphoria is the emotion that you should be having, especially right now in an environment where it seems like the consumer is starting to pull back. I think a lot of this euphoria is Fed driven, but ultimately we really need to focus on the consumers and the individual companies and how they expect to perform and look at each of the opportunities individually. And I'm seeing fewer opportunities right now than I saw earlier in 2023. So I'm less optimistic, despite the fact that the market seems to be more optimistic, at least than they were in late November. And this brings me back to a 1986 Berkshire Hathaway annual report. And, I'm starting to feel this where, right now I'm currently finding no equities that come close to, meeting my tests. And this is kind of what they were saying back then. And these are some really key points that Buffett made in this annual report. And I'll just read it to you guys here. What we do know, however, is that occasional outbreaks of these two super contagious diseases, fear and greed, will forever occur in the investment community. So right now, if we're in a more greedy environment, it doesn't mean that fear won't take over sooner or later. And so just be aware of that and don't feel like you have to chase returns. Even though in my last video, you saw a video of Charlie Munger, or not a video, but you saw a quote from Charlie Munger saying, oh, you almost have to take on some of these tech positions at higher valuations. I still disagree with that, although I will humble myself and say that, that man is much more intelligent, much more accomplished than I am. I just don't believe that I would want to invest in anything that I'm not comfortable investing in at a valuation that I'm not comfortable investing in. I do believe that a lot of us who watch this channel, we're young enough to know that we're going to experience a market where there's going to be a ton of fear, and that's when we're going to wait for those opportunities to come to us, and we'll drive what prices that we'll pay. And we saw that in 2020. When everything collapsed, there were some amazing values. We were seeing some sustainable companies with 20% dividend yields, which was absolutely nuts. I do believe that it's not a one-off type situation. That was a quick down and up, but I do believe that situations like that will occur again. And so what Buffett goes on to say is, we will never try and anticipate the arrival or departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. And, as this is written, little fear is visible in Wall Street. Instead, euphoria prevails. And that's kind of how I feel this market is right now. I think there's a lot of euphoria. But the question I have, and I showed you guys a chart previously with the valuation of growth stocks versus the valuation of value stocks. Ultimately, these growth stocks, and I think the market as a whole, has to perform at almost like a perfection level to meet the valuations that it has. And I just believe that companies don't perform at a perfection level for a long period, like for a long-term period of time. I think everybody runs into roadblocks. And so this point I think is more important. Everybody knows the greedy, the quote where it says, be fearful when others are greedy and to be greedy when others are fearful. But in that same report, I think a lot of people miss this one. I think this is the more important one, which is when times are good, remember that stocks cannot outperform businesses indefinitely. Ultimately, something has to catch up, and it's the business that has to catch up. And so does the stock decline or does the stock stall? There's a very, very famous case of, Walmart stock running up considerably and then just did nothing for 20 years because the company had to catch up to the valuation of the stock. And, that could happen with some of these tech names, or the opposite, where the valuations come down to meet the companies where they are right now. I don't know what the answer is, but essentially what I'm trying to say is that I am not comfortable in investing in anything where the valuation is higher because of FOMO, fear of missing out. I'm not going to do that. I'd rather just stay in cash, happy to collect my 5% and move on. I just go to work every day. If I'm going to have to go back to baking, if I'm going to have to go back to, learning to smoke different types of meats, whatever, I'll get any type of hobby. Hell, I'll even watch sports if that's what it means. I mean, I already watch the UFC pretty religiously, so that's probably not going to change. So then comes the question, how exactly am I approaching investing in 2024? Well, I am very fearful. I am now back to a significant... Now, mind you guys, none of this is a recommendation for you guys. This channel is not a recommendation channel. But I'm now back to a significant amount of cash, just like I was in 2022 and in 2019. I remember having a conversation with someone saying that, the market's a little bit long in the tooth back in 2019. And then we had just an insane decline in the market in March of 2020, and that provided us with a lot of opportunities. And so here's my specific investment strategy. I'm going to be reviewing the tracker every day for mispricings. The market may not go down, but there might be some company or industry specific things that happen that we see in the tracker. So every morning at 9:30 or, closer to 10, because it takes, there's a 15-minute delay. So 9:45-ish, I review the tracker to see where the stocks have opened up and see what the prices are relative to their intrinsic value. Now, if you don't know what the tracker is, just hang in there. I'll show it to you in a second. I'm going to be researching small cap names and looking for mispricings. I think a lot of the large cap names are picked over. There's a lot of competition there, but there might be some small cap names that have mispricings. But it might not be that things are picked over. There might be macro events that present value and people are aware of it. So it's value hidden in plain sight. Think of the 2023 bank shock. Right, a lot of those bank stocks went down. That was value hidden in plain sight. And so if you just dug in, it was asking for you to do a lot of work. You'd have to dig into every single bank, create a tracker, blah, blah, blah. Like, there was a lot of work, and I did the work and I gave it to you guys at the Patreons for no additional cost at that call tier. But, it did require work, but there was a lot of money to be made. If somebody said, hey, they're going to pay you $100,000 to do 100 extra hours of work in that year, well, you're getting paid $1,000 an hour. Why wouldn't you do that work? And so that's the way I thought about that. And so even though I had COVID at the time, I did all the work, or I did as much work as I could, and we found quite a few opportunities, and there was a lot of money made there. Now, the other thing I'm going to be doing is building out the comp trackers. Look, I built a comp on bank companies, but what if there's an issue that happens with insurance companies? What if there's some dividend payers right now that have high yields, that those dividends yields are expected to go down as interest rates decline? Well, here you have an opportunity to have a higher yielding dividend security in an environment where if the yield goes down, the price has to go up. So there is some potential opportunity there as well. So I'd like to build out comp trackers on insurance companies and start speaking about dividend payers on this channel as well. I think there's a lot of value that I can provide talking about dividend payers, because I look at dividend payers the way a value investor should be looking at dividend payers, and I just don't feel like there's enough of those people on YouTube. Now, finally, I'm going to constantly be reviewing options pricing and opportunities. I discuss every month win-win types of opportunities on our monthly calls. I don't recommend you guys to buy any of those or anything like that, but the whole idea is that there are certain situations where heads, if you get exercised on the option and you lose the security, say it's a covered call, you made a really acceptable return. And tails, if you have to keep the security, well, you have a net purchase value which presents you with a double-digit equity yield into perpetuity. And so either way, you're comfortable with that options opportunity. Now, there's close to 200 of you that are already subscribed to the Patreon, but this is what I mean. This is the tracker that's provided, and you can gain access to all of my research at that lower tier, $5 a month. And hey, if you subscribe and you find that there's no value, I will absolutely refund your $5. I don't want to take any money from anybody who doesn't find value in what I provide. And so really what you can do is you can see, because this is sorted every day, what the share price relative to the intrinsic value is of the particular securities that I've researched and put on the tracker. And if you want to know exactly how I build up to that intrinsic value, for example, Best Buy, how exactly do I get to the $101 per share valuation when the company's trading at $76 per share? Well, you can click right here, go into the model, and then you can decide to agree or disagree. And you have the ability to download your own tracker, build your own model, and then you might just have a model that has a different valuation than I have, and there's a lot of Patreons that do that. And so I think having a tracker is a very valuable tool in this environment. And so that is how I'm looking at investing in 2024. Step one, I'm just leading with fear. And step two, I'm waiting for the opportunity to come to me. There might be a company specific item, there might be an industry specific item, or there might be a macro item. And we saw all three of those situations occur in 2023. We will see those occur again in 2024. And the best thing we have going for us is we are smaller investors, and we can invest in many different types of opportunities that the larger mutual funds or the Berkshires cannot invest into. And so we should be able to grow our portfolios at a rate that's higher than the big guys. But that doesn't necessarily mean that it's guaranteed, because we are also susceptible to information risk, where we may not necessarily know how to get all the information that's relevant to the investment, or we may be susceptible to sort of like emotional issues, whether we're even willing to invest in the security or willing to admit if we're wrong on a particular security. So there's all that stuff that plays in. And so I'll leave it there. I want you guys to let me know how you guys are investing in 2024. And if I'm going to say one last thing, it's meow.